Remax Metropolis welcomes you back to Mortgage Unplugged with Jacob. Thank you for being here with us today, Jacob. Happy New Year.
Same to you.
I feel that every day even we find something that's new, something challenging, something that rocks the boat and shakes us up.
Yep.
The very recent Trump takeover of Venezuela. Let's talk about that a little bit to begin with. Does that have any impact or effect on Canadians, the mortgage, any aspect of where we feel we need to know things?
Yeah, for sure. So any kind of political or economic instability will always have some sort of effect on our mortgage rates. Typically, lenders will keep the rates a little bit higher in periods of instability in order to make sure that they have a buffer should anything unpredictable happen. They're not giving bottom dollar rates and maybe losing out on some interest that they could be charging the average consumer if the Bank of Canada should drop rates in order to stimulate the economy in a situation where it needs to be stimulated. I think if the last few years have taught us anything is that we really don't know what's coming. And I think the bottom line for the average consumer, the average Canadian mortgage holder, is just make sure that the mortgage term you're choosing really aligns with your goals, your timelines, your family's financial picture. Taking a risk and choosing a variable rate just to save a little bit of money may not be the best choice in the environment that we're in right now. But of course, everybody's case is different, and it comes down to really analyzing somebody's financial situation and their outlook, and just making sure that you're protecting yourself and your family with this very large debt that you're taking on based on where we are in the economy right now. And if there's uncertainty in the future, what I'm recommending to most clients is to choose a fixed rate, just so you have that peace of mind on a month-to-month basis, what your payments are going to be, not having to lose sleep at night, thinking about where the Bank of Canada is going to go next or what the US presidential administration is going to announce next. I think that brings a lot of value and can help you, from a mental health and emotional perspective as well, knowing that your mortgage is kind of a set it and forget it for a period of time.
Right. And I completely agree with you. I think there is no cookie cutter, there's no one size fits all method to this. And I think that takes us perfectly into this week's segment where we talk about traps, we talk about rates and terms, what they mean, and how we can coin them and how we can maybe use them towards our own advantage of the understanding of each of them. So walk us through, if you would, just simply the difference between a fixed and a variable rate, amortization, and just renewal strategies. I know you spoke about it briefly just now, but if you could elaborate a little bit on those.
For sure. So when it comes to the fixed versus variable conversation, it's always about the level of risk that you're willing to take on. In a typical market, a variable rate is usually a little bit lower than a fixed rate. So they're a little bit more enticing because your payment is slightly lower, the rate is slightly lower. But the risk that you're taking on is that should there be any fluctuations in the Bank of Canada's rate, the general borrowing rates set by the Bank of Canada, there could be a fluctuation in your payment and definitely a fluctuation in the interest cost of your mortgage. So a fixed mortgage, very simply, your payment will not change for the term of the mortgage, whether you choose a 3-year fixed or 5-year fixed. Your payment is going to stay the same, and your interest costs are outlined in your amortization schedule that you should be getting when you sign that term of the mortgage, so you know how much you're paying over 3 to 5 years. Simple and reliable and brings peace of mind to a lot of people. With the variable rate, you are taking on the risk that should rates change, should the Bank of Canada announce any rate hikes or rate cuts, your interest costs will change depending on the type of variable payment you have. So there's static variable and there's adjustable variable. Every lender offers either one or the other. And if you have an adjustable payment, it means your payment itself will actually fluctuate. And if you have a static payment, it means the interest portion of the payment will increase or decrease, and the principal portion will increase or decrease accordingly as well. So what happened to a lot of people who chose variable rates in 2020 or 2021 is, and they had the static payment, meaning the payment was not going to change, they ended up getting to a point where their entire payment was going towards interest, and the lender would call them and say, so here's where we are right now, you're paying only interest, we need to do something to make sure that you're paying down the mortgage and staying on schedule with your amortization. So a lot of people had to manually increase their payment when they didn't expect to, or make a lump sum payment towards the mortgage when they didn't expect to as well. So those are the risks. It was very clearly outlined to us in the last few years what the risks of a variable rate are, and I think a lot of people are a little bit scarred from that experience if they did fall into that that group of people. So a lot of people are shying away from the variable rates, and I think that's the right decision for a lot of people at this point as well. Just going back to the economic instability that we are experiencing, the set it and forget it for a longer term fix is typically what I'm recommending to my clients.
Okay. And so following that, what then happens with the amortization period when that ends or that term ends? What are the options?
Yeah, so say you start your mortgage with a 25-year amortization and you choose a 5-year term. When your mortgage comes up for renewal, you will have 20 years left on the amortization. If you didn't make any accelerated payments or any lump sum payments through the term, you'll just stay right on track and you'll have 20 years left on the mortgage basically. At the renewal date, and a lot of people are coming up for renewal this year in 2026, since 2021 was a very big year in real estate for us. So you have the option to basically do whatever you'd like with your mortgage. You could re-amortize it back out to 30 years to help with cash flow, because a lot of people are coming off of a rate that's around 2% and they're renewing into a rate that's around 4%. So you're going to see an increase in your payment, and a lot of people are choosing to re-amortize or stretch the mortgage back out to 30 years just to help with their cash flow over the next 3 to 5 years. So that's something that you can do. Okay. You can also shop around to make sure you're getting the best deal. So your existing lender will send you a renewal offer and they'll say, here's what we're offering for a 3-year fixed, 5-year fixed and variable. And then you can get in touch with a mortgage professional and get a good second opinion on, are these good rates? They can help you maybe negotiate with your lender, or they can set you up with a new lender to get a better deal somewhere else.
Would you recommend either or for a specific buyer profile? So let's say I'm an investor, would you go for a specific product, or if I was an end user?
Yeah, it's a good question. My opinion personally is that for an investment property, I think knowing what your expenses are going to be on a monthly basis brings a lot of value. I know there are a lot of investors out there that like the variable rate because historically variable has had lower interest costs, although the COVID period was kind of a bit of a blip in that data set. But if it was me investing, I would go for a fixed rate just so I know what my budget is on a monthly basis, and you have your income, you have your expenses, and you know kind of where your cash flow is. But there are a lot of investors that do, they're diehard variable borrowers, and it is what it is. But if I was making a recommendation, I would say lean towards fixed.
Okay, all right. And there's a myth that they say that the lowest rate offers the best mortgage. Is that true?
In some cases it is, and in some cases it's not. What I would be wary of, and this kind of it goes into the what to watch out for, or the traps, is that some bottom dollar low rate mortgages are what we would call no frills mortgages, or not a full featured mortgage, and they do have some restrictions. The most serious of the restrictions would be something like a bona fide sales clause, which means that you cannot break the mortgage unless you are selling the property. So the lender will not let you break the mortgage unless you are actually you have like a sale agreement in place. So refinancing or paying off a part of the mortgage or something like that, or paying off the mortgage in full if they're not selling the property, is not an option with those types of clauses. And they may offer great rates and it would be very enticing, but we have to think about the statistic that over half of people do end up refinancing their mortgage at one point, and first-time buyers typically don't spend the full first 5 years of the term in their mortgage. So there's a lot to consider. Read the fine print, get a second opinion. I think that's the most important advice.
Right. I was reading an interesting fact. It says 0.5% difference rate can mean over 10,000 saved or lost over 5 years.
Yes.
Would you say that was accurate?
I would say for sure. I mean, it goes back to a discount product may end up being the most expensive product because maybe it breaks at some point. Maybe you need to replace it or something like that. So it goes back to what I was saying, that a low rate mortgage with restrictions may cost you a lot more in the long run, and having more of a full featured mortgage with maybe a home equity line of credit attached to it. Portability features is important, meaning that you can move the mortgage from one property to another. So in the event that you do need to upsize, or you need to move laterally or something like that, being able to move your mortgage from one house or one property to another, it definitely it's a valuable feature to have.